Yeah, but there's a lot there that deserves some explaining. Not mansplaining, just explaining.
Oh, I don't like it when you mansplain to me on the show. I like when you do it in private.
I got it.
All right, so this from the Kabisi letter. Another big call by Apollo, and Apollo is a very reputable firm. Inflation will likely be above the Fed's 2% inflation target for the rest of 2024, which, for those who've been following along, means that the Fed would be unlikely to cut rates. If inflation rises at its current pace for the rest of the year, then core CPI inflation will increase to 4.5%. I'm going to explain this out a little bit. We saw inflation dip down. And if you listen to the show and you go back, you know that we have said we were concerned about ever getting to the 2% target rate because home prices would have to come down. There would be a point. There would be this inflection point where inflation would not go any lower because shelter needed to drop to get there. And all the pundits in the real estate market were like, no, man. No. Okay? Housing is not the problem. Rates are the problem. Right. And if you recall, we got really pissed off. Because, Said, you know better than most, what is the solution to everybody in the real estate market for affordability? What is their solution?
Rates to come down.
It's never values to come down.
Right.
It's always rates to come down.
Rates to come down. I mean, that's a problem that's always going to be there. But the reason why housing needed to come down in order for this inflation problem to get under control is because it just makes up so much of the number, right? It makes up 35% or 34% of the CPI number, and I believe 18% of the PCE number.
Yeah. Arun, go ahead and mute the computer just in case.
Yeah, did that.
Like on the last show, you were watching sports, by the way. I caught you.
Yeah, I was.
Yeah, I know.
Was?
I heard the audio from the sports when I was editing the show. Son of a bitch.
You know why I did that? You got comfortable.
Yeah, real comfortable.
You gave him like 3 or 4 compliments throughout the show.
I'm like, you're paying so much attention. Little did I know. All right. So let me tell you how profound this inflation pivot actually is. To get inflation back to the Fed's 2% target rate, right? Core inflation, core CPI for the rest of the year will have to come in at an unprecedented 0.1% month over month. Unprecedented, for those of you without a big lexicon, means it's never fucking happened before. Okay?
Since they started tracking this data.
Yeah, it has not happened. So unless we have an unprecedented, never before happened scenario where inflation is that low for that long, you got two choices, two likely scenarios. Scenario number one, the Fed says, hey, we are not going to hit 2% in target inflation, but we need to cut rates. That is probably the least probable scenario at this particular juncture in time. Scenario number 2, Fed says, you know what, guys? We got a problem here. We're not going to be able to cut rates. Sorry.
Yeah.
The straight line lower inflation data seen in 2023 is officially gone. Now the question that the Kabisi letter and many other people in the ecosystem, in the ether of the world are posing is, could there possibly be hikes this year? And let me tell you why. This article, this post is not saying it. The chart that Arun just brought up is a chart showing inflation's trajectory, core CPI.
And what is core CPI?
Core is core inflation.
Yeah, when they remove food and energy.
Food and energy, sorry. I didn't realize you were asking me for the technical definition.
Yeah, for the new listeners.
Yeah, okay. No, you're right. I'm wrong.
Yeah, the reason why they removed those this is what the Fed likes to look at when they remove food and energy is because food and energy is viewed as more volatile.
Yeah, this chart shows 4 possibilities. It shows you core CPI year over year, but then it shows you what would happen if core CPI came in at 0.1% month over month. Again, unprecedented. So never happened. It would be a straight shot all the way down. Unlikely. What if it came in at 0.2% month over month? It wouldn't be a straight shot all the way down, but it'd still be angling down.
Right.
You know, that's low. It's improbable. What if it was at 0.4% month over month, the last 3-month average? Guess what? That's going the wrong way.
Right. It is.
And of course, if it's 0.3% month over month, the last 6-month average, it's also going the wrong way. It's still going positive. So all of this to say, there was an event historically which is starting to seem more and more apparent. And if you listen to the early days of the show during the Fed interest rate hiking cycle, we talked a lot about 2 different economic events historically. One, the 1980s.
Yep.
1980s had a double dip recessionary economy. When you dip, I dip, we dip.
That's good.
Right? 1970s had hyperinflation.
Mm-hmm.
This is beginning to look like one of those two scenarios may be reoccurring in some way, shape, or form.
Right.
We could see a double dip. Now, the argument is, have we been in a recession? Have we not? Is it going to be hyperinflation where inflation is going to rise without more and more, aggressive pushes down vis-a-vis rate cut? I don't know the answer to that, but I know something is changing.
And this is why Jerome Powell and all the members at the FOMC did not want to come out and celebrate too early when everybody else was out there. Come on, hurry up, cut rates, we're good. Inflation's on a downward trend. They understood that, look, this could very much easily reaccelerate again. Yeah. Their plan, they got it down from 9.1%, right, all the way down to 3%, okay? And then what happened? January's figure came in hotter than expected, 3.1%. February, 3.2%. March, 3.5%. That's just going in the opposite direction. The big issue with March was there was no longer seasonality at play. We covered this on the last episode.
We did.
Right? What is seasonality? What are some things that looks like what seasonality can impact this inflation number, right? You got energy, right? Can impact the winter months, right? That's how it impacts the January figures probably, or maybe even some February figures. People have high heating bills and whatnot, right? You have people going back to school shopping. These are just examples of seasonality issues. During the springtime, I mean, yes, real estate starts to pick up a little bit, but it's not like it is in the summertime. In January and February and in December, you're dealing with holiday seasons, right? So real estate tends to die down a little bit because nobody's looking to buy during those months, or not nobody, but it's not as much activity out there. So the March figure really, shined a huge light on the problem.